discuss retail delivery fees, or RDFs, taxes levied on e-commerce transactions in the form of delivery fees imposed on retailers that ship products to in-state customers. These fees generally apply to deliveries of tangible personal property to a location within a particular state. Think of how often consumers go online, place an order, and have items delivered to their door. Are you in favor of or opposed to retail delivery fees? The arguments are as follows. In favor of imposing retail delivery fees, states need revenue to fund transportation infrastructure projects and maintenance. Retailers, on the other hand, oppose the enactment of retail delivery fees and are likely to pass on those costs to consumers. Why have states begun to consider enacting these fees? Because states have historically relied on motor fuel taxes to raise revenue for transportation infrastructure, but gas tax revenues have been in sharp decline. Why? The advent of mass-produced electric and hybrid cars and trucks, coupled with the availability of more fuel-efficient vehicles. According to articles published by the Pew Charitable Trusts, transportation funds in many states are precipitously low, so low that many states are well behind achieving the necessary amount of investment to maintain existing roads and bridges and begin new transportation infrastructure projects. This situation, coupled with an increase in the use of electric, hybrid, and more fuel-efficient cars in the United States, has resulted in great uncertainty regarding the methods states can use to maintain, repair, and build new state and local roads and bridges. The result of all these economic forces, states continue to consider the expansion of the tax base through taxes levied on e-commerce transactions. Retailers are generally opposed to RDFs because the fees will negatively impact their profit margins and cause compliance burdens. A group called the Chamber of Progress, a center-left tech industry policy coalition, lists among its projects the No Doorstep Tax Project, which provides arguments in opposition to delivery taxes, resources, and news stories regarding the issue. So while states consider enacting a retail delivery fee, there has been a great deal of pushback, and to date, the number of states that currently impose such a delivery fee still stands at only 2. Another option that states might consider as a response to the decrease in the amount of fuel tax revenue generated for transportation infrastructure project and maintenance costs is a VMT fee, or a vehicle miles traveled fee, which is imposed on drivers based on the distance they travel and applies equally to all vehicles in the same weight class. Only 8 states, Arkansas, Indiana, Iowa, Louisiana, Missouri, Mississippi, West Virginia, and Wisconsin, have had no involvement to date with VMT fees. The latest state to propose a VMT is Illinois. On February 6, 2025, Illinois introduced Senate Bill 1938, the Road Usage Charge Act. The bill would, if passed, require that the Illinois Department of Transportation develop and implement a statewide pilot program by January 1st, 2026 to assess a user fee on owners of motor vehicles that is based on the number of miles traveled on public roadways in Illinois by those vehicles. The last action on Senate Bill 1938 was on June 2nd, when the bill was re-referred to the Assignments Committee. In conclusion, states are under pressure to find alternative methods to finance essential and costly transportation infrastructure costs. They will have to weigh the benefits and costs of these fees and decide if they are in the best interests of their citizens. Ultimately, Whether a state enacts a retail delivery fee or a vehicle miles traveled fee will have to depend on each state legislature.